Administration and liquidation. General considerations. Pre-liquidation tax planning is crucial since tax planning opportunities are significantly limited once liquidation begins. Corporation tax is due on profits generated during the winding up process. All assets, including chargeable assets, which may result in capital gains, and trading assets, which may result in trade profits, will be disposed of during liquidation. Assets distributed to shareholders as dividends in specie, i.e., non-cash assets, are deemed to be sold at their market value for tax purposes. Accounting periods. In administration, an accounting period ends, and a new one begins when a company enters administration. Subsequent accounting periods align with the original accounting date until the company exits administration or enters liquidation. In liquidation, an accounting period ends, and a new one begins when the winding up process commences, typically marked by the appointment of a liquidator. Thereafter, accounting periods end every 12 months until the winding up is completed. Tax implications of asset disposals. Chargeable assets, including land and buildings, disposal results in chargeable gains or capital losses. Trading inventory, disposal results in trading profits or losses. Plant and machinery, disposal triggers balancing adjustments on all capital allowance pools. Intangible assets, disposal results in trading profits or losses. Treatment of trading losses. No carry forward after cessation of trade. Trading losses cannot be carried forward once the trade has ceased. Current period and brought forward losses can be used to offset gains or profits during the winding up process. Terminal loss relief available, allowing losses to be carried back up to 3 years against total taxable profits on cessation. Planning point: consider selling assets with unrealized gains before trade cessation to offset gains with available trading losses. Group implications. Parent company liquidation. If a parent company enters liquidation, it severs the group relief group, meaning group relief is no longer possible between any group members. Chargeable gains group. The chargeable gains group remains unaffected, allowing group members to still benefit from chargeable gains relief. Distributions to shareholders. Individual shareholders. Pre-liquidation, distributions are treated as dividends and subject to income tax. Post-liquidation, distributions are treated as a capital disposal of shares, subject to capital gains tax. Corporate shareholders. Pre-liquidation, distributions are generally not subject to tax, as dividends are exempt from corporation tax. Post-liquidation, distributions may be exempt from tax if the substantial shareholding exemption (SSE) conditions are met, otherwise, gains are subject to corporation tax. Company purchase of own shares. From individual shareholders. Default treatment, treated as a distribution, resulting in a deemed dividend subject to income tax. Capital treatment may be possible if specific conditions are met, potentially offering a more tax-efficient outcome. From corporate shareholders. Treated as a capital disposal of shares, and any resulting gain may be exempt if the substantial shareholding exemption conditions are met. A quick reminder about accounting period ends when working with corporation tax. The timing of the accounting period end is critical as it determines the period into which income, capital profits, and losses fall, affecting the use of reliefs. For example, trade losses of the current or carried back year can be set against other income or gains. Carried forward losses can only be set against trading profits. If a company's business becomes small or negligible during a loss-making period, HMRC may deem the trade to have ceased, even without formal cessation. Gains from asset sales after this point are treated as chargeable gains, not trading profits. Unrelieved trading losses can only offset future trading profits, not chargeable gains, meaning such gains may still be taxable despite remaining losses.